You don't lose in the market. You lose in your mind.
This is Trained Mind Trading, the channel for traders who know what to do, but still don't do it. And here, you'll train your mind to finally change that.
Have you ever wondered why it is just so incredibly hard to walk away from a bad decision? I mean, whether it's a relationship that's clearly fizzled out, a career path making you completely miserable, or a stock portfolio that's practically in free fall, human beings seem to have this spectacular glitch in our programming. So today, we're going to unpack exactly what that glitch is, how it silently dictates our choices, and, most importantly, how to beat it. Okay, picture this relatable scenario.
The night is young and the music's loud. Shout it out with the roaring crowd.
You dropped $50 on a concert ticket weeks ago. You're pumped. But now, the day is here, you feel absolutely awful, and it is pouring rain outside. I mean, miserable weather. Do you still go? Be honest. If you're like most of us, you'll probably drag yourself out of bed just so you don't waste that $50. But rationally, that money is already gone, whether you go brave the storm or stay home in your warm bed. Or, hey, how about this one? You're 30 minutes into what is just a phenomenally boring, terrible movie. Do you sit through it to the bitter end just because, well, you've already started? What's really interesting here is that studies actually show younger people are far more susceptible to sitting through that terrible movie just because they've invested the time. Older adults, on the other hand, are actually way better at just cutting their losses and walking away. So what's actually happening under the hood here? Well, we call this the sunk cost fallacy. It's the tendency to keep going with something once we've invested money, effort, or time into it, even when giving up is without a doubt the better idea. This cognitive glitch basically forces us to irrationally justify what we're doing right now based on irrecoverable past investments. We are quite literally making decisions based on resources that don't even exist anymore. It's like this constant tug of war in your brain, right? On one side, you've got pure rational decision-making, which is telling you to look strictly forward at future costs and future benefits. But on the other side, irrational sunk cost thinking is pulling you back, fixating heavily on what you've already spent. Logic is practically screaming at us to look forward, but our emotions, they anchor us completely to the past. Now, you might be thinking, am I just doomed to repeat this error forever? Well, check out this data from a University of Warwick study. Susceptibility to this fallacy actually varies quite widely from person to person. Some folks naturally find it a bit easier to let go, while others hold on with an absolute death grip. So this isn't just some abstract philosophical idea, it's a highly measurable, very real quirk of human nature. Section 1, Why We Cannot Let Go. Let's dig into the biological roots of this issue. It really all boils down to a deeply ingrained survival mechanism known as loss aversion. This is a cognitive bias where the psychological pain of losing something is roughly twice as powerful as the pleasure of gaining that exact same thing. Think about it. Our ancient ancestors survived by aggressively avoiding losses. So today, the mere thought of wasting that concert ticket triggers an intense biological pain response in our brains. It actually hurts. And to show you just how irrational this pain response makes us, listen to this famous study. Researchers told people to imagine they accidentally double-booked 2 overlapping ski trips. One trip cost $100, the other was $50. Now the catch was, they were told the $50 trip would be significantly more enjoyable, but they could only pick one. Astonishingly, 54% of people chose the less enjoyable $100 trip over the awesome $50 one just because the initial financial investment was higher. They literally chose to have less fun just to avoid feeling like they lost more money. Crazy, right? Section 2, the Concorde fallacy, a multi-million-dollar mistake. Okay, so ruining your own ski trip is one thing, but world governments do this too, on a massive, catastrophic scale. We actually call this the Concorde fallacy. Back in 1956, a multi-government project started building a supersonic passenger plane. By the 1960s, the development costs had just completely skyrocketed. By the 1970s, there was undeniably clear evidence that the financial gains would never, ever offset the costs. But did they stop? Absolutely not. Despite knowing it was a financial disaster, they kept pouring millions into it simply because they'd already started. It ended up flying at a massive loss all the way until 2003. Section 3, Sunk Costs in Trading, the ultimate crucible. If you want to see this fallacy on steroids, look no further than the financial markets, where it destroys portfolios every single day. If you think trading is all about spreadsheets and complex math, think again. An astonishing 85% of long-term trading performance is actually tied to psychological factors, not the actual quality of the strategy. You can have literally the best trading algorithm in the world, but if you can't conquer the sunk cost fallacy in your own head, the market is going to eat you alive. Our brains are practically master illusionists when it comes to rationalizing a losing trade. First up, we've got confirmation bias, where a trader tells themselves, oh, the fundamentals haven't changed, completely dismissing clear evidence that the trade is failing. Then there's anchoring bias, where you think, I'll just sell when it hits my entry price, fixating totally on a past price that the market doesn't care about. And finally, optimism bias, where we dangerously overestimate the chances of recovery, thinking the market will magically turn around any second now. So what is the real-world cost of holding on? It is absolutely devastating. Traders wait desperately for that mythical break-even moment, or they stick to failed strategies while the whole market evolves around them. This emotional block alone can drag your annual portfolio performance down by 20 to 30%. And worse, with your capital trapped in a losing trade, you miss out on 40% of better investment opportunities. Your survival brain makes you hold on way too long, because closing the trade, that makes the loss real. And hey, if you've ever caught yourself thinking, I'll just buy more of this losing stock to average down my cost, brace yourself for this number. 68% of retail traders who added to their losing positions ended up with losses that were 2.8 times greater than their initial risk. By trying to average down and save a bad trade, you're actually compounding your errors, turning a completely manageable little mistake into an absolute catastrophe. Section 4. How to outsmart yourself. Okay, so we know our brains are essentially actively working against us. How do we fix it? Well, you need systems that bypass your emotions entirely. Here are 3 super actionable exit strategies you can use. Number 1, set clear exit rules before you even enter a position, like a strict stop loss. Number 2, use data-driven tools that run on cold, hard metrics, not your gut feelings. And number 3, track and analyze your past trades in a journal. By predefining your risk limits when you're calm, you completely eliminate those dangerous emotional decisions in the heat of the moment. And we aren't just guessing here. The data backs this up big time. Studies analyzing millions of trades show that folks using strict stop-loss orders saw 16% higher returns. And look at the institutional level. Citadel Securities used AI-driven exits to cut the time they spent holding on to losers by 53%. That one move boosted their overall performance by 12%. Pure objectivity actually works. Ultimately, the ultimate trick to outsmarting the sunk cost fallacy is a complete perspective shift. You have to understand the concept of a prospective cost. A prospective cost is simply a future cost that hasn't happened yet. It offers you a clean, unburdened opportunity to change course and make a better decision. So the secret is shifting your focus away from the irrecoverable sunk costs of yesterday and looking toward the prospective costs of tomorrow. You've got to look through the windshield, not the rearview mirror. So, as we wrap up this explainer, I want to leave you with something to really chew on. Take a hard look at your own life right now, your relationships, your career, your habits, or your portfolio. Ask yourself this very uncomfortable question. What losing investment are you refusing to let go of today? Is the fear of a sunk cost keeping you trapped from a much better future? Take a breath, cut your losses, and step forward. Thanks for joining me on this deep dive into the human mind.
That's one more pattern. Named, understood, and now in your hands. Becoming a profitable trader isn't about the next setup. It's about becoming the person who can follow it. Subscribe for your regular bite of wisdom. Train the mind, the trades will follow.